It's a bit of a sore subject right now. What's going on, everybody? Today, I'm going to give you the top 5 stocks I love for the month of August. So sit back, hit that like button, and let's get to the first one, which is Square. Just last night, Square said early external access of the company's quarterly financials forced it to release earnings one day ahead of schedule. It was a shock to all of us in many ways. I even took to Twitter myself and asked what the hell was going on, as they got released about an hour before after hours trading was closed. Nevertheless, they absolutely crushed earnings, which we didn't see coming as a surprise to those of us who are in the Chaos crew, did it? Hey Steve, can we get a hell yeah for Square?
Hell yeah!
Thanks, man. Click the join button below if you don't want to miss out on watch lists I put out each morning before the market opens, so you don't miss out on the next one. Why is it still a buy after this earnings run up? Just look at these numbers. Square said gross profit rose 28% from last year to $597 million, while revenue surged 64%, which beat expectations, coming in at $1.92 billion. Square said it processed around $873 million in Paycheck Protection payment loans over the quarter, while overall quarterly gross payment volumes grew 17.5% to $26.8 billion. Pretty likely we're going to see another stimulus sooner or later, which it would appear that Square could stand to yet benefit from again. Then you have Square-owned Cash App, where total monthly active accounts are over 30 million, and the number of Cash Card holders reached 7 million, which is doubled when compared to last year. Cash Card spend was up 50%, with the cash balances stored in accounts, which is 86% higher than last quarter alone. This is absolutely incredible, as we are seeing higher demand for frictionless transactions that have been exacerbated by the Rona. But even after we get past the pandemic, demand won't change here. The cat's been let out of the bag, and there's no putting it back. It's never been easier to spend money, and Lord knows we all love impulse buying. Hey, speaking of impulse buys, how's that plan with Kodak going? You know what, bro? It's a bit of a sore subject right now. Oh, sorry, bro. Sorry, that's my bad. Well, moving back on the Square, the two companies that are at the forefront of this frictionless transactions are PayPal and Square. The growth we're seeing in Square has me thinking that they may start to gain the upper hand in active users very quickly, though. And let me know what you think about the surprise earnings as well. Were you holding on to Square and was just as shocked as I was, or is it that you plan on buying some up now that you've seen these earnings? Let me know in the comments below as we get on to the next stock, which is Apple. Ticker symbol AAPL is currently trading at around $438 a share as of this recording. And in case you've been living under a rock, it has just had some ridiculous earnings, and within those earnings, they announced a 4-to-1 forward split. So what does this mean? Once a company IPOs or goes public, it gives retail and institutional investors a chance to purchase shares of its stock. There are a number of moves it can make to increase its price to make the company look more appealing. Many companies go the route of a stock buyback, which will decrease the number of outstanding shares. And what does that do? It simply increases the value of shares that you hold. Simple supply and demand here, right? The more scarce the shares become, the more valuable they are. However, sometimes what a company may do, and what Apple did, was announce a stock split, which is essentially the opposite of making shares more scarce. In Apple's case, they are increasing the amount of available shares, 4 shares to 1, which will bring the price of the stock down to around $100 per share, give or take. So why would they do this? The easy answer is because it looks better to your untrained eye. A cheaper looking stock usually brings on more buying because then it becomes more affordable, especially to retail investors who have smaller accounts. And this is why I love Apple as a buy right now. In the 44 years of their existence in the stock market, Apple has had 4 stock splits, with its most current one being the 5th. 3 out of those 4 splits saw incredible runs into the split itself. The only time it didn't was the dot-com bubble, and well, everything tanked back then, and almost nothing was immune at that point in time. Owning Apple before the split could lead to some really good opportunities post-split, because of the amount of buying we will likely see once Apple becomes more affordable to investors. Why could this be good for you? Well, let's just say that you have 2 shares before the split happens. This means that for every dollar that Apple moves, your position will move $2 one way or the other in its current form. Post-split, that will change to $8 for every dollar per share that Apple moves. The value of your position remains unchanged, but the rate at which you make money on Apple rapidly changes, and given the demand we've seen in Apple over the years, it would make sense to be in this before a rush of investors come in to buy cheap shares of Apple stock. Now, I say all that because the iPhone 12 release is said to be right around the corner, with rumored reports that it could be as early as September or October. And it's also rumored that they will be a 5G phone, as well as having a 3D camera and new size options as well. What do we know about Apple and new iPhone releases? The stock almost always goes up as a result. And if it does indeed have 5G tech with it, and you now have 4 times the shares you had before, this could really be a good opportunity for some serious profit. Apple is one to own anytime, but especially now. Next is Clorox. Now, I brought Clorox to the channel back when it was well below $200 a share, and it now sits at $235 as of this recording. I am more confident than ever $300 a share is coming for this thing in the fourth quarter of this year. Look, the Rona, it's changed the world of cleaning forever. In its latest earnings report, in which it did end up beating by a ton, Clorox stated that there will likely be a shortage of Clorox wipes until 2021. They're struggling to keep up with demand, which is just mind-blowing to me. But Clorox is more than just bleach and wipes. They also own brands such as Glad, which if you're at home more often, means that you're probably making more trash and in need of more trash bags. Pine Sol, because if you're at home more often, your floors are probably getting dirtier faster. Brita filters, because you're probably drinking more water at home. At least I hope you are. And let's not forget Liquid Plumber, because if it's one thing I've noticed more, it's the insanely hairy animal that shows up in my shower that is created from a certain somebody at home, not named Brad. I don't know if any of you run into the same problem, but it's pretty scary looking, and I don't want any parts of it. And Liquid Plumber does the job for me. There's a ton of other brands as well as Clorox, and the wipe shortage isn't going to slow the stock down anytime soon, in my opinion. Clorox goes higher, and I can easily see this at $300 in the short term. And of course, let me know what your thoughts are on this one. Do you think that a Clorox wipe shortage will hurt the stock, or do you think demand is enough to keep this train rolling? Let me know in the comments below as we hit number 4, which is Peloton. Ticker symbol PTON is continually surging to all-time high after all-time high, and this is something that you should not be afraid of. It was first brought to you a few months ago when it was sitting below $30 a share. So if you got into it then and have been holding all this time, incredible job on this one. If you didn't, there's still opportunity to make some decent money at this price point, in my opinion, though. Peloton sees $100 soon, and here's why. How many of you watching this now have a gym that's actually open that you can go to? If you do, how safe do you feel about going and using their equipment and trusting that it is safe to even use? Chances are you don't. And this is where the insane demand for Peloton comes into play. The demand they have seen for their bikes and treadmills has been through the roof, but it's more than that for me. The real value here is in their recurring revenue and not just the upfront cost of the bike itself. With Peloton products, customers get access to a virtual community and a high-quality product that allows them to exercise while still staying safe at home. Their earnings report last quarter revealed that they were having trouble keeping up with demand. Despite that, they were also one of the very few companies who raised their outlook for the year and expect revenue to hit somewhere between $1.72 and $1.74 billion this year, which would mean an 89% year-over-year growth. I think they beat that with their upcoming earnings report slated for early September. Companies raising outlooks is the perfect segue into this next stock, which is Fastly. And my hope is that they have beaten earnings today as I post this video. Please let them have beaten earnings. Fastly was first brought to you back in May when they also lifted their outlook for the year and expected growth of over 50% this year and was priced at $34 a share then. I don't think they expected it to continue to benefit from the pandemic waging on this long though, and my bet is that they beat it today, but I guess we'll see. Whether or not they beat earnings today, though, makes no difference to me, as this remote work play is here for the long haul. It may have seemed like a small company just a few months ago, but remote work has dominated the market, and Fastly is fastly approaching elite status. The company is a content delivery network. They focus on helping their clients develop fast websites and apps with a focus on cybersecurity. This plays a huge role for companies who are becoming more focused on remote working, which we all know how bullish I have been in this area of the market, and that it's not going away anytime soon, period. Rona or no Rona, remote work is here to stay, and Fastly will continue to benefit here. With clients such as JetBlue, BuzzFeed, Airbnb, Twitter, Pinterest, Shopify, the New York Times, and Vimeo, I only see this list growing from here. It was a buy 2 months ago. It's a buy now. Thank me later. End of story. And that's the end of this video. So if you like this and want to see more, click this video here where I poke some fun at and praise the top 10 stocks that were bought on Robinhood last month. Trust me, you'll love it. It's hilarious. Please like and subscribe. And as always, folks, I will see you all before the bell. And B. Smith is out.